Do you think it will happen? It's getting close. And if it does, is that necessarily some kind of canary in a coal mine for recession, or simply more of the way people have been buying one bond over another?
Yeah, it's not necessarily going to point to a recession in this case. We have a lot more going on in the economy than we did 50 years ago when this was perhaps more of a reliable signal. And by more, I mean we have monetary intervention that we didn't have back then. We have fiscal intervention that we didn't have going on back then, and we have China's economy and Europe's economy and the U.S. economy kind of three cylinders instead of one now.
You look at everything that the global economy and the American economies really, Mark, are dealing with right now. Let's walk through it very quickly. Inflation's out of control and going to get worse. The Federal Reserve is aggressively going to tighten rates. By the way, the bond market has already done the Fed's job for it, which is kind of what we just talked about, whatever the Fed ends up doing. You've got, obviously, Putin's war in Ukraine. And, oh, yes, the second biggest economy in the world is locking down its biggest city over 50 COVID cases. I mean, the amount of stuff this market and investors are up against right now is truly incredible.
Absolutely. And, how was the market responding to this cocktail of uncertainty last week? Well, it was sending stocks higher, in part because there's so few alternatives to equities right now because of the factors you mentioned, like inflation and higher rates. But, the way that we're thinking about this is focus on the areas where there's less uncertainty. And for us, that's around commodities and energy-related equities, because we think that these sanctions are going to remain in place whatever happens with the peace talks, which we certainly hope make some progress, because this is a terrible humanitarian tragedy. And then the other thing, of course, is, as you mentioned, the inflation. And that's why we're looking at things like financial stocks and U.S. senior loans. And we're also starting to see some value in parts of the investment grade bond market.
Yeah, and what you said is a very important point, Mark, that we just talked about in the previous segment with Dan Tannenbaum, which is, even if the war ends, and let's all hope and pray it ends tomorrow, even if it ends, whether or not Putin stays in power, those sanctions are going to remain as long as he is. And that's not a political view. I'm sure UBS has its own house view, but that's just a recognition of his now role as a war criminal in the world. So I would imagine you're talking to your clients and saying, listen, if and when the war ends, don't expect inflation, I assume, and correct me if I'm wrong, Mark, to simply go away.
Well, there's two parts to that. And I think first, the historical record shows that sanctions tend to be very sticky, regardless of these outcomes. But also what's supporting the commodity complex and the energy equities is we do see a stronger world economy as things come out of COVID into the back half of the year. And that means that it can be a little weaker because of some of the things that have gone on and maybe some demand destruction around higher energy costs. But the reality is that the demand for oil and energy is going to be strong into the back half of the year. So that will be supportive. On the other commodities, it's not just the Ukrainian wheat crisis. It's the fact that we're in drought in most parts of the world. So the demand picture is also supporting this into the back half of the year. Now, on the inflation
commodities,
picture, commodities
are
supported. Yeah, commodities are supported, and the energy equities. The inflation picture, we are hopeful still that some of the inflation pressure will back off in the second half of the year, and that will give the Fed a little more flexibility.